Today, I want to talk to you about the difference between owning rental properties in your personal name, which is the previous way people would usually own rental properties, to purchasing within a limited company, which is a separate legal entity. And the difference in those two things. Firstly, I want to talk about a personal name. This is the most common way that people would purchase properties in the past. They would buy them in the personal name, then set as personal income on their end of year tax return, and they would deduct the mortgage payments and management and maintenance and be left with profits, which would be taxable. And you'd have taxable profits if you own things within your personal name. Now, back a couple of years ago, the government introduced something called Section 24. They no longer allowed you to deduct mortgage payments from your income before you were taxed on it. So you're now being taxed on your gross rental income, which is a huge disadvantage to anybody that owns property within their personal name, because before you might be able to deduct a huge percentage of your income because it was a mortgage payment. So you would take the mortgage payment off and then you would present that as your taxable profits that you would then get taxed on. But nowadays, they've wiped that and you actually have to pay tax on the full amount. So if you're earning £1,000 a month gross on a property, then you cannot deduct the mortgage payments, the management, the maintenance. You are paying tax on that £1,000 a month, which is a little bit unfortunate, and just, I guess, the government tightening regulations on non-professional landlords. So we're likely to see a bit of an exodus of non-professional landlords exiting the market, and even landlords that have a combination of professional and limited company properties. They're likely to be selling off their ones in their personal name while we've got a little bit of capital gains allowance still left, and before they impose more tax implications on landlords that own properties within their personal name. So let's talk about the flip side now, where you would own something in a limited company. Limited companies are much more tax efficient structures, if not always, not for everybody, and like always, this advice applies individually to different people, so you should speak to a tax accountant on your personal situation before you heed this as advice and just hammer on with it. But if you are buying in a limited company and you're not looking to buy maybe one or two houses and keep those as like your retirement pot, and you're not on a higher income threshold already, so a little side note here, if you are on a lower income threshold, below earning less than £50,000 or so and paying only 20% tax, that's the postman, then buying in your personal name might not be a terrible idea, because it will only take you up to that 20% tax bracket. So you will only be paying 20% on that extra income. But if that obviously that's a relatively low amount for today's living conditions. But if you're looking to buy more properties or scale a property portfolio or buy multiple properties over the next whatever period of time, your lifetime, then it's probably a lot more efficient to buy things in a limited company where you will only have 19% corporation tax. You'll be able to deduct your expenses, your management, your maintenance, and any other fees that are associated with the business. So fuel costs if you're driving back and forth the property, maybe even vehicle costs if the vehicle is used exclusively for property, or you can get it proportion to the amount you use it for the business versus personal use. Again, not a tax advisor, but just trying to help you guys out, where if you're making profits, then you can deduct those expenses before the profits are taxed in a limited company. So you will be taxed 19%, which is lower than the lower tax threshold rate at the moment, although they are talking about putting that up. Probably going to go to 25%, but that'll be when your profits are above £50,000. Expenses still allowed to be deducted from that. But if you earn income into the limited company and you've deducted your expenses and then you've got taxable profits, you pay your 19% tax, and then that profit is yours to be used, is capital to be used within the business to purchase more properties, purchase assets for the business, purchase things within the business that you need to use, or actually take that money from the business and bring it into your personal name. There's tax efficient ways to do that. So you can take a salary, although that's considered relatively tax inefficient, particularly if you've got other sources of income. If you don't have other sources of income, then it's worth taking some salary. Again, speak to your tax accountant, get his or her individual opinion on your situation. But you can also take your profits as dividends. So the dividend tax rate is currently 7%, but taking things out at 7% dividend rate will be a lot more efficient, particularly if you're a higher rate taxpayer, because then that is only 7% income on those properties and you've had all the expenses deducted. So yeah, I would say If you're thinking about purchasing properties for the long term, and you're sort of anything between 20 and probably 40 or 50 years old, you should be setting up a limited company to purchase properties in. If you're on the tail end of your career, you're looking to retire, you only want a handful of properties to be able to pay you in retirement, and you're not going to have any other income, then maybe then it's worth having properties in your own personal name. But I would say for the most people, it's going to be a limited company setup. So hope that was helpful. If you found that interesting or valuable, then drop us a like and a follow below.